I am Benjamin Graham. Let me explain Mr. Market. My name is Benjamin Graham. I spent the better part of my career observing markets and the people who participate in them. My goal was never to predict what markets would do next. That struck me as a fool's errand. Instead, I wanted to help investors protect themselves from their own mistakes. And if I could offer you only one idea from all my years of study, it would be this simple illustration I once used in my teaching. I called it Mr. Market. Early in my work, I noticed a pattern that troubled me. Intelligent people were losing money in the stock market, not occasionally, but regularly. This puzzled me at first. These were not fools. Many were educated, careful in their business affairs, and otherwise sensible in their daily lives. Yet in the market, they behaved irrationally. They bought when they should have been cautious. They sold when they should have been patient. I came to understand that the problem was not a lack of ability. It was emotion. Fear and greed are powerful forces. They cloud judgment. They turn steady people into speculators. So I developed a teaching tool to illustrate how markets actually behave, and more importantly, how an investor ought to respond. I introduced this idea to my students as a character, a useful fiction to clarify a very real dynamic. Imagine that you and I are partners in a private business. We each own a share. The business is sound. It earns money steadily. It has genuine value. Every single day without fail, a man named Mr. Market appears at our door. He makes us an offer. He will either buy our share from us or sell his share to us at a price he names. Now, here is the difficulty. Mr. Market is deeply unstable. Some days, he wakes up euphoric. The world looks bright to him. He sees nothing but opportunity ahead. On these days, he offers us a very high price for our share. Other days, he is despondent. He sees only danger and uncertainty. On these days, his price is quite low. His mood swings are extreme, and they are frequent. One week, he is convinced the business will thrive forever. The next week, he believes it will collapse. And because his emotions change so rapidly, the price he quotes rarely reflects the true worth of the business we own. Now, this is the central point, and I cannot emphasize it enough. Mr. Market does not exist to guide you. He exists to serve you. You are never required to accept his offer. You are free to ignore him entirely. In fact, on most days, the wisest course of action is to do exactly that. The market provides you with prices. That is its function. It is a mechanism for transactions, nothing more. It does not provide you with wisdom. It does not tell you what something is worth. That determination is yours to make. Yet I observed again and again that investors behaved as though the opposite were true. When Mr. Market arrived in a cheerful mood, offering high prices, investors felt reassured. They interpreted his optimism as evidence that all was well. They bought eagerly. When he arrived in despair, quoting low prices, they became frightened. They interpreted his fear as a warning. They sold in haste. In other words, they allowed his emotional state to dictate their own. They treated his prices as information about value, when in reality, his prices were information about his mood. This is a fundamental reversal of roles. The investor, who should be calm and analytical, becomes reactive and emotional. Mr. Market, who should be ignored or exploited, becomes the authority. This mistake is not rare. It is the norm, and it leads with great reliability to poor outcomes. My advice to investors was always straightforward, though I found it difficult for many to follow. Use Mr. Market. Do not follow him. When he offers you a price far below what the business is truly worth, you may consider buying his share. You are taking advantage of his pessimism. When he offers a price far above its worth, you may consider selling to him. You are taking advantage of his euphoria. But most of the time, you should do neither. You should simply let him continue on his way. You should focus on the business itself, its earnings, its management, its prospects, not on the daily fluctuations of his mood. Patience, I found, is not a passive quality. It is an active discipline. It requires you to resist the pull of activity for its own sake. It requires you to sit still when others are moving frantically. It requires you to wait for the right opportunity and to recognize that such opportunities are infrequent. Most investors believe that action is always better than inaction. I came to believe the opposite. In investing, doing nothing is often the most profitable course. Many years have passed since I first described this idea to my students. The technology of markets has changed beyond recognition. Prices move faster now. Information travels instantly across the globe. Trading occurs at scales I could not have imagined. The tools have changed. The speed has changed. But human nature has not changed at all. People still become euphoric when prices rise. They still assume that rising prices will continue to rise. They still become fearful when prices fall. They still assume that falling prices signal disaster. Fear still moves faster than reason. Greed still clouds judgment. The same psychological errors that plagued investors in my time plague investors today. If you understand that price and value are not the same thing, you protect yourself from the worst errors. If you remember that the market is there to serve you, not instruct you, you gain an enormous advantage, not because you will outsmart others, but because you will avoid outsmarting yourself. I never promised investors that they would become wealthy quickly. I never promised extraordinary returns or secret formulas. I promised them something I believed to be more important. I promised that they could avoid permanent loss of capital, that they could preserve what they had earned, that they could invest without losing sleep, without constant anxiety, without the need to watch prices every hour. This may sound modest. Perhaps it is. But in my experience, the accumulation of wealth is not about brilliance. It is about avoiding mistakes. And the biggest mistake is allowing Mr. Market to control your decisions. Mr. Market will always be emotional. He will always swing between fear and greed. You must remain rational. You must remain disciplined. You must remember that you are the investor and he is merely offering you prices. When you accept this, investing becomes less exciting perhaps, but it also becomes safer. And in the long run, safety is what allows capital to grow. In my next discussion, I will explain another principle that guided my work throughout my career. I called it the margin of safety. It is the idea that separates serious investors from speculators. It is the buffer that protects you when your analysis is imperfect, as it sometimes will be. And it is, in my view, the foundation of sound investing. This discussion is intended for educational purposes only. Thank you for your attention.